I completely agree with that. I almost think you'd scare the public.
Welcome back to Real Estate Mindset. Today, again, I have a wonderful guest here to collaborate about what's going on with the bank runs currently in the economy. And before we dig into that, let me show you who Jack is. Jack owns a channel called Nobody Special Finance. I absolutely love him. He does a lives Monday through Friday at 9 p.m. Eastern. Great guy.
AM Eastern?
Very.
9 a.m. Eastern?
Did I
Close.
say p.m.?
One of these days you're going to get that time slot brother. But today is not that day.
I don't know how that's possible. How do I keep messing this up? So sorry, you guys. Jack is a great friend. Just got done visiting him and brought him on today because we've got a lot of turmoil going on in the banking system. We have rumors of additional bank runs or bank collapses going on. So I thought, who better to bring an investigative reporter just like Nobody Special Finance to come on to talk to you guys about exactly what's going on. Jack, how are you today? Happy Sunday, brother.
I am doing great today, Travis. Thank you again for having me on. It's always a pleasure to work with you. And we got some interesting stuff going on in the banks. Maybe bank run, not quite the right word, but definitely a new banking crisis in the making here.
Okay, let's talk about that then. So what is going on as far as the banking system?
All right, so it was about 2 weeks ago now, we had the next phase, either the new bank crisis, if you want to call it a new one, or the next phase of the one from last year that started in March, because it involves what happened last year in March. It started about 2 weeks ago when a small bank called New York Community Bank reported their earnings. And when New York Community Bank reported their earnings, they reported a massive increase in their provisions for credit losses. They are setting aside $552 million for loans going into default. And that was a 790% increase in their loans going in default. So, I mean, they increased them pretty much ninefold, set aside a lot of money. And those losses were all due to commercial real estate in the United States. And now there was a lot of losses because of office buildings, something a lot of people are familiar with, that these office buildings, because of work from home and because of interest rates, not worth what they used to be. But also hiding within that New York Community Bank story was a problem with multifamily residential real estate, in particular rent-controlled multifamily real estate in New York City, public housing projects, some of the worst of the worst as far as places you could find yourself. Let's just put it that way. We'll try to be sensitive on this topic, but rough areas. And since New York Community Bank reported, we have had trouble at banks in Japan with a bank called Azora reporting losses from U.S. commercial real estate. We've had Deutsche Bank in Germany reporting big increases in losses, and we've had Deutsche Pfandbrief Bank in Germany reporting big losses in U.S. CRE. So commercial real estate in the States here is in the process of starting what could be a global financial crisis, a second one, all because of these banks from around the world all have exposure to loans on U.S. commercial buildings.
You know what's interesting, Jack, that you just helped kind of like open my eyes is like how big the problem really is. I mean, if it's affecting now other countries, Japan, Germany, because they're losing money on American commercial real estate, man, that could be, like you said, a global financial crisis, a global credit event. I mean, that's pretty wild, man. Continue, please.
Yeah, well, I mean, think about it. Every skyline in every city in the United States, every one of those little buildings, as you're crossing the bridge, looking at these magnificent city skylines, every one of these buildings is tens of millions, possibly hundreds of millions of dollars in losses. And those losses are everywhere. If you think that's not going to affect you, you're crazy. It's definitely going to affect you. The numbers are massive here. But in particular, it was these rent-controlled buildings in New York that really stuck out at me, because New York Community Bank, you may recall, played a role in the bank crisis last March when Silicon Valley and Signature Bank failed, along with First Republic, right? Second, third, and fourth largest bank failures in U.S. history. New York Community Bank was one of the banks that stepped in to rescue Signature Bank. They bought a large percentage of Signature Bank's assets. You know, the FDIC took Signature Bank into receivership. The FDIC dips into the Deposit Insurance Fund, which is money set aside for bank failures. They paid back all the account holders at Signature Bank. And then they took the assets from Signature Bank and they sold them to New York Community Bank. But I remembered at the time, New York Community Bank did not buy any of the rent-controlled buildings that Signature Bank had owned. They bought everything else but that. And I remember that stuck out at me last year saying, they already own so much of this stuff and they don't want any more. Put a pin in that mentally. Maybe that comes back to haunt us someday. And well, that day got here.
You're a smart guy. You're a smart guy, Jack. I had a quick question, if I may. Sorry to interrupt you, but I'm wondering, do you know why the rent control multifamily commercial is failing? Is it because of renovations or old buildings? Why is it specifically rent controlled?
So the rent control buildings in New York City are particularly vulnerable because there was a new law passed in 2019 that limited the annual increases in rent that were allowed in these buildings, right? In 2019, before the inflation hit. So then inflation hits with the unfortunate health situation that had happened in 2020. And now inflation becomes a thing because the Fed prints all this money. And then they decide, okay, we are going to raise interest rates to fight that inflation. Now you've got building owners who are renting out these buildings. Their cost of ownership has exploded higher. Gas, electric, everything is more expensive. Maintenance is more expensive. The interest rates on their loans as they mature, they're coming due. Now they need to refinance into a much higher interest rate. So their cost of owning this building, the debt service on the building, has exploded higher. And they can't pass that cost on to the customers because the city and the state said you're only allowed to raise your rent by a couple of percent every year. So they're basically in this legally mandated losses, the owners of these buildings.
Interesting.
So that's why these particular buildings in this particular city are coming to light now.
So to put this in layman's terms, essentially because there's consumer safeguards, they're defaulting. Is that correct, Jack?
I don't know that I would call them consumer safeguards as much as I'd call them government price controls, right? The government came in and said you're not allowed to raise prices, and now these buildings are going belly up. And, I'm a very much Austrian economics, free market kind of guy. Price controls always lead to shortages every time. When the government says you can't raise prices during times of strife or during times of shortages, well, the solution to high prices is higher prices. When prices go up, there tends to be less consumption, and that drives the prices right back down. We're seeing that in certain other markets right now. Now, obviously, housing, there's an emotional element to this, right? Because people being thrown out of their houses, people being evicted, especially poor people being evicted, that is a very emotionally charged subject. And so it's very easy to get a law like, hey, you can't raise the rent on the poor. It's very easy to get that in the books. But then, inflation happens and these other things happen. And now these building owners are going out of business. Well, now these building owners are cutting corners and they're not fixing things and they're doing all kinds of terrible things to try to stay alive. And the people living in the buildings are suffering anyway.
So let me ask you this, Jack. All right. Well said. I should have known I set myself up there. But let me ask you this. I mean, you see the point I was trying to make. I mean, they raised prices way too high was the point, but you're not wrong either. But New York Community Bank goes in March of 2023 and they purchase Signature Bank. Now they're going under potentially themselves. Who's going to save the Bank of New York? Who can save them, Jack, and not go out of business? Apparently, when you go try to purchase another bank right now in this toxic economy, you got a business. So who's going to save the Bank of New York?
I'll be honest with you, and we're going to touch on a couple of things. I think whoever steps in to save the Bank of New York are the people that you really need to take a look at. You really need to dive deep in because there are some really sleazy things happening with these public housing projects in New York and the people financing them, and even all the way down to the level of the people booking work to make minor repairs in these buildings. Theft, greed, fraud everywhere. And New York Community Bank, in my opinion, I don't think there's any saving them. And I think whoever steps in to save them will be doing so at tremendous cost to themselves. And the only reason I think anybody has to save that bank is to cover up what has been going on there. And,
wow, man. So you're saying there's potential that someone would just buy that bank just to cover up what's been really going on. But the thing is, Jack, what if what's going on is going on with every bank? And there is no covering. To a certain
extent, it is. This bank in this city with these buildings in particular is just a breeding ground for fraud because they take advantage of people's good nature. They take advantage of charity. They take advantage of good intentions to hurt people. It's really what they do. They enrich themselves at the expense of the taxpayers and at the expense of these poor people living in these buildings. And man, I've done some research on what happens in these buildings. The human stories in there, they're just awful. I'm not going to get into that right now, but just awful what's going on there. So let's talk a little bit about what happened. Why was I so suspicious? Because when I found out New York Community Bank was having trouble, I remembered the Signature Bank story, and I remembered that New York Community Bank didn't want to buy any more of these buildings. So I started thinking to myself, what happened to those rent-controlled buildings that Signature Bank owned? And I remembered I had a conversation with our friend Melody Wright about this during our road trip a few weeks ago. And that stuck in my head that there was Brookfield in particular. Brookfield is this real estate investment firm, and they wanted to buy the loans on these buildings, the loans on these rent-controlled buildings. And it turned out the loans on these buildings sold for 58 cents on the dollar, all right? Like so many buildings are selling for pennies on the dollar. But it sold to a nonprofit organization called the Community Preservation Corporation. And it sold for 58 cents on the dollar to this charity, the CPC. And Brookfield says, well, wait a minute, guys. We bid 80 cents on the dollar for this debt. Why didn't we get the buildings? We bid more. And the FDIC is selling these loans to recover the money from the bank bailout fund. So this money is needed. There's $119 billion in the deposit insurance fund at the FDIC that is guaranteeing $9 trillion of deposits. All right, so they need this money back for the next bank failure. So why is the FDIC turning it down?
Joe, to show the viewers what Jack is talking about is basically FDIC insures your money in the banks. They only have about $125 billion in assets. They can't even help one of the bank runs that we had, or one of the bank failures that we had last year. They can't even cover one. So in other words, the FDIC is just to make you feel better. Would you agree with that? I mean,
yeah, there was actually a sound clip that went around a few years ago. It was a year or two ago of the FDIC basically saying if people knew this, they would freak out.
If you put this out, like, why are they telling me this? Should I be concerned about my bank? Like, my insurance company doesn't tell me what they're doing with my assets. They just assume they're going to pay my claim, right? I think you've got to think of the unintended consequences of taking a public that has more full faith and confidence in the banking system than maybe people in this room do. More full faith and confidence in the banking system than maybe people in this room do.
Like a month later, we had our first bank run. So I was like, I told you guys the FDIC is a joke. They were laughing at you. I have that sound clip right now. They're laughing at the public belief in the banking system. I'm sorry.
And that video did not age well because the bank run started a few weeks later. I mean, that was pretty bad. So I'm saying, why did the Community Preservation Corporation get these loans, bid on the loans against these buildings when somebody had bid higher? And the FDIC said, well, we took less money for these loans because we wanted to keep questionable lenders from buying the buildings. Questionable. I'm like, what's questionable? I mean, I'm not a big fan of Brookfield. They're like these other commercial real estate firms that are sticking people with losses left and right. So I don't feel bad for them. But at the same time, hey, you got to recover this money for the deposit insurance fund for everybody else.
Yeah.
And so it turns out there's this obscure legal mandate, 12 U.S. Code Section 1823, where the FDIC, one of their priorities is to maintain affordable housing for the poor. You know, their priority is to protect the banks, protect depositors, to recover as much money as possible for the deposit insurance fund, to get as much for the assets as possible, but also maintain affordable housing. There's also a requirement about discrimination that they can't do in there. So they basically threw out most of their mandate and just stuck with this one line about maintaining affordable housing in this case. And that's why they took the lower bid. And okay, affordable housing for the poor, it's a noble pursuit. We might have different ideas about how to achieve that, but it seems like good intentions here. But the other thing that was interesting is that in that deal, when they only bid 58 cents on the dollar for these loans, they only bought 5% of the loans for 58 cents on the dollar. So the FDIC, the Bank Deposit Insurance Fund, is going to retain 95% ownership of these loans on these buildings that aren't worth anything. So the FDIC isn't even really selling it. They sold a token amount just to say they sold it. It's still sitting on the books of the Deposit Insurance Fund, which means that loss is still being socialized among the public. And then I said, well, okay, if Brookfield was questionable, what about CPC makes them unquestionable? Why don't we question CPC? Which had me start questioning CPC. That's just how my brain works. So I start digging into this Community Preservation Corporation, who now owns 5% of these buildings that were seized from Signature Bank, these rent-controlled building loans. And well, the first thing I do when I hear about a charity and they're involved in taxpayer dollars and things like that, I start looking into, okay, what do these guys make? The people running this charity. And I go to their executive compensation page because this is a charity, it's public filings.
Yeah.
Shout out to ProPublica, who does amazing work on this subject.
Okay.
CEO Rafael Sestero made $2.3 million in 2022 as the CEO of this charity, this nonprofit. And I did a video about this, and I remember saying, my grandma, what big not profits you have at your charity, at your nonprofit organization. This guy's bringing home $2.3 million to run this.
Maybe he works hard. Do you think he's just working that hard, Jack?
I work pretty hard. You work pretty hard. We don't make $2.3 million, and we're not doing charity work either. Right?
Maybe I should get into charity.
I'm not trying to saint myself here, but I do some charity work. I run into burning buildings for nothing. So, you know, like, hey, this guy's helping people find houses. It's a noble pursuit, but he's not doing it out of the goodness of his heart. He's getting $2.3 million to do it. And it's not just the CEO. There are 10 other executives that are making at least $500,000 or more. And there's another 20 on top of that that are making at least $200,000 or more at this place. There are dozens of executives making big bank at this place.
Do you know if they're hiring? I could use increase in income.
Yeah, we're in the wrong line of work here, brother. I can tell you that. All right. So right away, charity and 7-figure salaries, something's up with these guys. I start looking even deeper into CPC and what they do. And it turns out that these guys have had trouble during the global financial crisis, the 08-09 collapse. These guys got themselves into big trouble because it turns out back then their CEO was getting in trouble because he made $1.1 million. Joke's on him. The new guy makes double that. But during the GFC, it turned out of their massive loan portfolio at the Community Preservation Corporation, they're supposed to make financing available for these rent-controlled buildings. It turned out during the GFC, more than half of the loans that this place had issued were for luxury condo projects for profit. For-profit luxury condos. More than half of the $1.5 billion in loans that they issued during the GFC. Luxury condos, places with oak floors, balconies with ocean views, beachfront condos in North Jersey and New York. These guys are just pigging out. And of course, 2/3 of those loans went into delinquency during the GFC. And they're saying, hey, guys, you know, this is a nonprofit organization. They're not taxed. They get taxpayer funding. They get all kinds of grants. They work with all these public agencies. And they're building luxury condos for profit instead of providing public housing and paying themselves $1 million salaries while they do it. And now these are the guys who are not questionable, Travis. These are the guys that got the loans for 58 cents on the dollar because the questionable guys bid 80 cents. We gave it to these guys instead. So
that's shady.
Now, here's where it gets even better than this. And I did a video about this, and I couldn't believe the stink of it and the rot. And I feel for these people living in these buildings. It's so awful what happens in these neighborhoods.
Let me recap for the viewers.
Yeah, please.
So basically, this is what happened. The Bank of New York is going under. It's only a matter of time. The Bank of New York actually purchased a lot of the assets, commercial assets from Signature Bank back in March of 2023. Fast forward to today, the Bank of New York now has a 750% increase in defaults. And so now the FDIC has gotten involved. They're trying to get money back from bailing them out. And instead of the FDIC selling the loans to a company that's willing to pay more, instead of doing that, getting more money, they sell it to a company that appears to be greedy, corrupt, and full of grifters that are operating under the premise that they're a nonprofit organization, which to me sounds like a loophole that the greedy and corrupt just take advantage of. Is that a good summary so far, Jack?
It was. There was some minor nuance was off, like the 552 million that was in credit loss provisions. So they're setting aside money in case it goes into default. Doesn't necessarily
Okay.
mean it's in default already, but that
Okay.
you're in the right place there, right? There was some minor little details like that. And New York Community Bank bought the non-commercial assets from Signature. They bought everything, but they didn't want to touch the commercial because last year they knew it was toxic sludge and they didn't want any more of it.
But what's crazy, okay, so maybe they didn't buy that because their own portfolio wasn't performing.
Correct. That's why they didn't buy it. So then the FDIC kept the stuff from Signature Bank, that rent-controlled stuff, on their books. They only sold a little chunk of it, 5%, to this Community Preservation Corporation that's run by these guys who are paying themselves ridiculous salaries for the charity work. And I spit that word out when I say it because it's gross that they call themselves charitable when they're paying themselves $2.3 million in charity money. And I don't care what value they're doing. I don't care how proud of the work they are. There are people who do much harder things for a lot less, all right, and call it charitable. And now it turns out that superior bids are being turned away so that we can sell these loans at a discount in what is essentially a rigged auction. That's what Brookfield was complaining about. They said they carried out this auction in secret and turned away superior bids at somebody else's expense in order to sell these loans to this charity that got caught building luxury condos during the GFC.
Yeah. And meanwhile, you have all these tenants that are living in awful conditions, probably roaches, rats. I mean, what's going on with the tenants, Jack?
Okay, so let's get into the tenants now and their life. Because a day after I published this video, 1 day later, this story broke about NYCHA, the New York City Housing Authority. All right, these are the people that administer these buildings. 70 people who work for NYCHA were arrested on the same day for solicitation of bribes for maintenance work on these buildings. These 70 people, now these are like low-level building superintendents, supervisors, right? So,
but certainly a pattern of what
grifters at the top.
Yeah.
Right? Making millions of dollars of salaries. Now we're down at the low levels with the supervisors in these buildings and the superintendents. For $13 million of work on these buildings, these superintendents and supervisors took $2 million in bribes. Basically, if you're a contractor in New York and you want to get the work order to fix the plumbing in this old lady's apartment, you got to give me a little something for the effort before I let you have the contract. So it's not about being the best contractor or bidding the best price.
No,
are you greasing the pocket of the guy who awards the contract?
It's about greed and corruption.
Yep. And 70 of these guys got arrested on the same day. Now, $2 million in bribes for $13 million worth of work. That means that work could have been done for $11 million, right? So the bribe is built into the price that the contractor charges. And where is that stolen $2 million coming from? It is coming from the generosity of the taxpayers who are financing these buildings. It is coming from the rents that are being paid by these poor people who are living in these buildings. And it's coming from the misery of those people because some of these buildings are going 6 months without cooking gas because the gas line leaks underneath. And instead of prioritizing getting repairs done as fast as possible, these crooks are saying, how much can I get out of this personally before I award that work order? Instead of these people can't cook dinner because the gas is out and now they got to get expensive takeout just to eat. And okay, now their lives are even more miserable and they're even poorer. And honestly,
so
this greed.
If I'm corrupt, basically, Jack, if I'm corrupt, I should open a nonprofit. Is that correct?
I don't want to attack charities everywhere because there are so many good volunteer charitable organizations out there. And there are so many good charitable organizations that have paid staff because
but there are also
work full-time jobs and they deserve to be compensated. But then there are these charities that just
bad people. Well, bad people are taking advantage of what is designed to be good to help the community, to help people with their rent. But instead of that, they're taking the taxpayers' money saying, oh, where'd this money come from? Let me put it in my pocket. And they're letting the roaches get out of control. They're letting the mice get in the pantries because all they can think of is hell yeah, I got a nonprofit. Let's figure out ways to make more than 2.3 million. And by the way, Jack, there's a certain point where the money doesn't fill the hole in people's soul anymore. I mean, why do you need more than $2 million. I mean, what can you possibly do in your life that you need more? And I mean,
That's the
degree
word
of
there,
corruption,
Travis.
man.
More. That's the operative word there. It's not about how much. More is always the answer. That's the
So let me
problem.
ask you, and I apologize, you're bringing out a lot out of me. I mean, this just pisses me off. When I went to New York and I was walking through Central Park, I was looking around. I'm like, man, we got to fight all these families. We're so small compared to the greed and we're so small, Jack. I mean, we got to speak even louder. But let me ask you this question, okay? I mean, obviously, this is probably a trend. This is probably going on all over the place. If they had issues, if Signature Bank had issues, and now we see the Bank of New York is having issues. I mean, what happens, Jack, once this really starts spiraling out of control, and once people start realizing that their money is being held by lenders and banks that are straight up fraud? What happens to the banking system? What happens to credit restrictions? What happens next?
So, that's the problem, right? When the tide starts to recede, which is what's happening now, the saying goes, when the tide goes out, you find out who's swimming naked, because those economic tides pulling out as a result of the higher interest rates, it's uncovering where the rot is in the financial system. Silicon Valley and Signature were some of the first. Now New York Community is another. And when that happens, the fraud gets exposed, like I think is happening in and around these public housing projects in New York. What I see happening there with these highly paid executives and with these, lower ranking supervisors all pigging out at the expense of the generosity and the good intentions of others. To me, that is fraud. I don't know if that meets the legal definition or not. Time will tell. But I think we're going to find a lot more of this as this happens, as the financial hardship gets more widespread, more of these things will be uncovered, much like Madoff was uncovered in the lead up to the GFC. That's how we found out about that big fraud there. So what I suspect is happening, and what I plan to do, whoever steps in at some point to rescue New York Community Bank, and I think that's coming, I got to wonder, are they doing it because it's a good business move? Is it a good business move to buy all of these loans on buildings where the owners can't raise the rent, where they're basically legally forced into a losing business proposition? Who would buy that unless they're buying something else? And that's something else that I think they're going to be buying is going to be to keep a lid on whatever else is going on around these public housing projects in New York City, because we've already seen so much exposed in these last few weeks. And I think there's more coming. And I will be very skeptical of who steps in to rescue New York Community Bank. They're going to say it's a public service. They're going to say it's to preserve community housing. They're going to say it's to help the poor. Well, we're going to hold them to that. We're going to make sure.
Jack, I heard info, I haven't confirmed this myself, that when we look at just, for example, Chase, pretty big bank, if Chase goes under, we all go under. Let's just say that. I've been reviewing information that is stating that Chase has an overwhelming amount of commercial loans. And obviously those are going down in value, those are going defaulted. So if we find out eventually, obviously it's probably the lag effects that are happening right now from the quantitative tightening. But if we find out that the whole system has been fraud this entire time, I mean, don't you think that can create some type of banking catastrophe, some type of catastrophe for where people can't even borrow anymore?
I do think there is that potential. I was just talking to my father about this over the weekend. George Gammon did a bit about this, and he said it all boils down to trust, right? Things broke down in the global financial crisis because in the middle of the night, one day, nobody trusted the other banks that they would make these big overnight repo loans back and forth to, because nobody knew who was insolvent because of mortgage-backed securities. And when that trust broke down, nobody would lend to anybody. And so we could see something like that with commercial real estate. Now, honestly, this conversation is the first I'm hearing about Chase. It's been my understanding that most of these commercial loans are hiding on the balance sheets of small banks and people's retirement plans. Chase is a first. I'm going to have to look into that one. So that's the first I've heard of that. But your point is well made, right? If nobody knows who's holding that, nobody's going to want to do business with anybody until they find out who's safe and who isn't, who is a counterparty risk and who's not. So I can see this potentially leading to further contagion, I don't want to use the word panic because I don't want to be accused of trying to start one or anything, but there is a risk notably, in my opinion, it's America's small banks have the biggest risk right now because they've been forced to buy a lot of this stuff, a lot of these commercial loans. And extend and pretend has been the approach for years. We've known for a while, especially we've had too many stores, too many retails. We've known that for over a decade now since the Amazon effect. And yet these shopping malls all over the country are still operating. How? They all lose money. Well, because they extended their mortgages. They pretended the buildings are still worth more than they are. Some bank made a loan to that mall to keep operating. They didn't care because they knew they were going to turn around and sell that loan, probably to grandma's pension in the form of a commercial mortgage-backed security. So they extended the debt. They pretended the building was worth more than they are, and the risk continued to grow in the system. Now interest rates are higher. Yep. Extend and pretend is not working anymore.
Yeah, and that extend and pretend helps with the lag effects. Like people are like, oh, we've been in quantitative tightening for 2 years. Nothing has happened. Well, if anyone thinks that nothing has happened, I want to challenge the viewers to go to Google right now, literally go to Google on your cell phone or wherever you're at and type in commercial foreclosures. Literally, I feel like, Jack, every single day there is a new building that is in foreclosure or in default. Every single day. And it's hundreds of millions. It's only a matter of time before they get to the end of the road. And we're going to figure out that this whole time they've been shafting us. And the problem here, Jack, is the biggest problem here is if they bail out these banks, it's possible, if it doesn't lead to unemployment, that it's just going to make inflation worse. It's possible. I mean, and then I ask myself, as a consumer, as a taxpayer, I pay my taxes. That's not fair. I don't want to pay my taxes to these nonprofit organizations that are going to pay $2.3 million and get 58 cents on a loan. Yep. That their job is to help people, but they're helping the luxurious. I mean, to me, it screams fraud. It screams corruption. At the end of the day, if the enforcers are in cahoots with these people, then nothing's going to get done. And if this has been going on since the GFC and now it's the same company doing it, that tells me that the enforcement's in bed with these people. If this could continue to get on, and this is not fair, Jack, when we look at the housing market, 70% of America is priced out. People are saying, oh, the bad buyers are coming back right now. And it's no. Things are more unaffordable now than they were last year. That buying box is even smaller now overall. There's some metros that I believe are crashing in prices. But my point is I can't help but sit back and think, how much of this is a result of greed and corruption and fraud? And when I sit back and we're just talking about one bank that has put aside $552 million. I mean, $552 million. I mean, come on, man. I mean, this is nasty, Jack. This is nasty. What do you see happening next? What do you see happening in, say, let's go a year from now in 2025? How do you see that landscape of the banking system playing out by 2025?
Well, based on what I have seen so far, right, with the bank failures last year, the FDIC stepped in, seized the banks that failed, sold off their assets, right? You had JP Morgan bought up First Republic's assets for pennies on the dollar. They got a great deal on that, right? JP Morgan got bigger. The big banks get bigger. That's probably going to continue happening. More consolidation. Smaller banks die. Big banks get bigger. And remember, the GFC was all about too big to fail. We can't have too big to fail anymore. Well, we just keep getting bigger and bigger and bigger, fewer and fewer. So now, if 2008 was too big to fail, what the hell do you call today? I don't know. So big banks get bigger. That's one thing I see playing out. I have a hard time seeing the FDIC. They bailed out uninsured deposits last year. That was a big thing. That was money. The Deposit Insurance Fund is money that was set aside for FDIC insured accounts up to $250,000, right? But most of the accounts at Signature Bank and most of the accounts at Silicon Valley Bank were not FDIC insured. Most of them were uninsured depositors, wealthy people with amounts above the $250,000 limit.
Oprah.
Yeah.
Gavin Newsom.
Oprah can't lose money. Come on. What are we, barbarians?
Roku. They bailed out the freaking politicians and elite. Well, yep. I promised Danielle DiMartino I wouldn't use the word bail out for specific reasons. It was, and then obviously the bank term funding program. I understand the philosophy.
She was very big on the nuance of that. I remember that discussion. Yeah.
I mean, her thing was the bank term funding program had $2 trillion that it could have bailed banks out, but only 176 billion was used of the 2.5 trillion. So therefore it didn't consist of a full-blown bailout. But I would certainly say, well, the banks that did take advantage of it, which were the smaller banks, certainly did get bailed out. But her premise is as well.
Expensive debt too. The BTFP debt was at 5% interest, so it was pretty expensive.
Right.
Even that mutated into this pig out arbitrage opportunity. Like one of the reasons why the bank term funding program usage exploded in the late last year, beginning of this year, was because the interest rate on overnight reserves at the Fed was higher than the interest expense of borrowing from the bank term funding program. So all the banks started borrowing as much money as they could from the BTFP just to turn around and lend that money right back to the Fed for an even higher interest rate. So that's another thing I expect to see happening is whatever provisions that they roll out to try to save the banks will be used and abused by the pigs to enrich themselves, like just happened with the BTFP.
Two questions. Do you see two things I'm interested in? Can you see bank failure happening in 2025? And can you see in certain situations where the depositors are burned, where they do actually do a bail-in, and if someone has over 250,000, they lose the difference of the 250,000 compared to how much? Did you see that? And do you also see credit restrictions? You know, I follow a lot of the housing market, and one of the things I haven't seen on a mortgage level is meaningful restrictions. I mean, in some situations, Jack, they've lowered the restrictions, especially on FHA mortgages. When you talk about the MIP, the mortgage insurance premium, they lowered it. They made it easier to get because the DTI is now lower, because the expense is now lower. So what do you see happening with depositors and potential bank runs and credit restrictions, specifically credit restrictions?
So depositors not getting their money back from the DIF, that's a political consideration more so than a math one. I do think we could conceivably see the circumstances where the DIF does not have sufficient resources to make all the depositors whole, especially if they keep insuring uninsured deposits, right? Like they did with Silicon Valley and Signature and First Republic. That being said, I don't think the politicians will allow people's money to disappear in the banking system. That would be 29 all over again, especially when you consider the uninformed nature of the public, financially speaking. It's much easier to just go ZIRP and BRR, zero interest rate policy, and money printing in order to create the money out of thin air to give people back their deposits, right? That could happen because most people think they're being given something when money is printed. They're not. They're just stealing wealth from existing money. So I think that's the more likely outcome, that we get some kind of QE, maybe one of Danielle's not QE things like the BTFP was. But I think we will get an expansion of the money supply to make depositors whole before we see depositors going to the bank and their money's gone. That's just the political wins. I think that's the more likely scenario.
Okay, and the restrictions?
The credit restrictions, make sure I'm answering the right question here, but I do think the banks will start getting defensive. I think we'll see a breakdown in interbank lending as nobody knows who's solvent, who's not solvent. And so they all stop lending at the same time, which causes a momentary explosive move upward in overnight interest rates, like we saw in the lead up to the GFC, like we saw with repo madness on September 17th of 2019. And then when that happens, usually the Fed steps in right away to just dump money into the market to lower the price of money, to lower interest rates.
But Jack, you know, and you may be right, that may be what they're doing. But I mean, I can't help but sit back and say, like, hey, this isn't the GFC. You've already did money printing. We're in this situation because of money printing. So they want to do more money printing. To me, that sounds like a recipe for a second or third round of inflation and a total freaking collapse, because they just won't let the economy bust, as is a natural and healthy thing. But they don't want to let it bust because it seems to me that there's so much toxicity, greed, and corruption at the very top. And they've been there for decades, and they know all the loopholes. They got their hands in the laws. And so, you know, and that, to me, the scarier thing here, Jack, is doing money printing. That's a scarier thing for me. And hopefully society's starting to wake up, like, hey, those checks that we got in our bank account, that just stole from your future.
Yes,
they just stole your future, guys. Like, that's all that happened. They fooled you because they hung a carrot up, like, hey, you guys want this 2,000? And so many people are like, yeah, let me get that. Not realizing that you're going to pay back that 2,000 times 5. And that's what we see at the grocery stores, the housing market, auto loans, interest rates going up on credit cards. I mean, the money printing scares me drastically because we've already printed that money, Jack.
Travis, it's very easy for them to do this because, again, this is a very emotionally charged, politically charged, even racially charged topic, affordable housing. And so when corrupt organizations, banks, charities that pay themselves millions of dollars, these grifters that are demanding bribes and kickbacks for work on the buildings, when they get into trouble, they will lean on the good intentions of people to say, if you don't come bail me out, then you don't care about poor people. Then you don't care about affordable housing. You want to see this poor old lady on a fixed income be thrown out in the street. And that's how they get more money. That's how they prey on people's generosities. And people who are in the public trust administering programs like affordable housing, they need to be held to the highest possible standards of ethics and conduct because of the trust and because of how important their work is. And they use the victims and they use the poor as human shields for theft and for greed. And they use it to escape any questioning, any accountability, right? Brookfield was a questionable lender, and at 80 cents of the dollar, they were turned away, and we gave 58 cents on the dollar to this unquestionable charity who was building luxury condos in the GFC.
And so the reality is,
higher standards.
Is the nonprofit probably has less regulations than the actual lender that was making the offer. So they actually gave it to the company that can be in disguise even more. And that's really crazy. Now, Jack, having said all of this stuff, what can consumers do to potentially get ahead of uncertainty? And obviously we don't want to scare people and paralyze them, but also we don't want to lie to people and hide things. And so, Jack, what message can we end on here on what consumers might want to do?
I think it's important for people to be to educate themselves on FDIC coverage because, all of the uninsured people got bailed out in Silicon Valley and Signature. I think sooner or later we'd get to a situation where they'd have to stop trying to cover all the uninsured deposits. So keeping yourself below that FDIC threshold, I think there's a wisdom in that. Even if it means spreading out your money a little bit among several different banks, staying under that threshold is important. But also understand, guys, that FDIC illusion, it's smoke and mirrors, because really what that is backed up by is the government's money printer. And if the government backs up your deposits with printed money, they might make you whole nominally, but by the time you get it, they've inflated that value down to where it doesn't really buy as much as you think it does. And, I keep a little brick of silver here. I like to store a little bit of my money outside of the financial system in inflation protected assets that protect me from that worst case scenario, right? I'm not saying put all your money under your mattress outside of banks or, buried in your garden or anything like that, but have at least an emergency fund safely away from these people that can be protected from their money printers. Because I do think we are going to see that second wave of inflation, like you described, that they're going to turn the printer on and it's going to come back.
I mean, there's only so much weight you can put on the consumers, man. And I'll argue right now, like, hey, man, this is because of, the lockdowns. I mean, that was unnatural. I mean, the entire economy is artificial. The entire growth, it's money printing. Everything is artificial. This is not normal. We were lockdowns. When have we ever been in lockdown? So the normalization of this is just it's just such a lack of leadership and transparency and honesty. And it drives me absolutely crazy because what we went through, Jack, is far from normal. It's far from fundamentals. And we know how powerful sentiment is. I mean, literally people's emotions are breaking the laws of supply and demand. I mean, how people feel is king. And it's crazy to me how that works, actually. And that's why, obviously, the Fed looks at inflation expectations and things like that. But I think that you nailed it, man. I think that we cannot forget what is going on behind the scenes. We can't forget what happened in 2023, because if we do, we're just going to keep our heads in the sand. What we can do is we can play defense. We don't have to be scared. We can play defense. Don't put more than 250. I don't even have 250,000. So that's fine. And then maybe go to the bigger banks, maybe not the regional, maybe do some, out of the bank, maybe like gold, silver. I do T-bills as well, and diversify. But don't keep your head in the sand. My God. And you guys, again, I'm going to give Jack the last words here, but don't forget to go to his channel once again, guys. Nobody Special Finance. I mean, this guy's a great person. It's really important for him to get things right. He's an investigative journalist. I like to call him also a nuclear scientist, maybe. I don't know. But this is a great guy. Show him some love. Tell him that Real Estate Mindset sent you. And Jack, anything you want to end on, brother?
Yeah, I am not against affordable housing for the poor. I am not against helping people in need. I mean, I help people in need myself. I understand it. Don't let these people hide behind that. Don't let these crooks use that good nature to make themselves rich at the expense of you and the people they're claiming to be helping. That's what I hope people take away from this. These people, especially in New York, what they're doing in those buildings, it is disgusting. And keep a close watch on them, because a couple of them were exposed recently. There's more.
Well, what do you think people could even do? I mean, if the officials are in bed, what can they do, Jack? What can they do to not let that happen?
The people that are in these buildings report these crooks. And if you report them to the authorities and nothing happens, go to the press with it and report these people in the press. And if the press won't cover it, come to me and I'll cover it, because I'll cover things the press won't cover, because I'm not protecting anybody's interests. I don't have advertisers. I don't have banks that need to be appeased, so I'm afraid of saying something bad about them. Shine a light on this. Sunlight is the best disinfectant. That's what consumers can do.
Okay, great advice, man. Definitely appreciate you guys. Sorry for the long video. We're at 46 minutes. If you guys are out there depositing your money, we wish you luck and we hope you win.